Then let's continue how to calculate the WACC based on the market value of each of the financing sources. The last time we calculate how to get the beta and then how to get the CAPM, which is the required rate of return. So the WACC is calculated by the portion, the market value of the cost of debt, market value of the preferred stock out of total, market value of the common stock. The reason why we are using the market value is that we want to measure the present value of common stock, present value of the entire business, right? At this moment, how much actual is borrowing? How much is the actual borrowing? So we need the market value because all the interest or the compensations or dividend or free cash flows is based on the current value, right? So we use the market value, okay, not the book value, which is historical, the acquisition cost. Now we have the market value of Apple information, but we also have those the book value information. The last 2020, the September 30th, the fiscal year end of the Apple Inc. Then we are going to use the long-term debt from the book value. Wait, we are using the market value. Why do I use the book value? In terms of when it comes to the debt is kept updated by the present value calculation as we learned in the financial accounting. So we can freely use the book value of the non-current liability, which is the long-term debt, into the consideration of the market value of debt when we calculate the weighted average cost of capital. Okay, but the market value of a stock, we are not using the equities, we are not using the preferred stock from the book value. Okay, so let's get started. The input section, the price of preferred stock. Do we have preferred stock? No, only the common stock and the long-term debt, right? So the price of the common stock is not applicable. So all this information related to preferred stock is not applicable. The price of the common stock per share as of March 26th is 121.21. I found it from the Yahoo Finance. Okay, that is the March 26th, the closing price. So $121 that I put here. Again, you have to put, if you type down any kind of hard number on the input section or output, you need to explain where to get it and how to get it. Then the common stock outstanding shares. Where do you get these outstanding shares? Okay, again, the 10K is including all the value of information, recent information. Who made this? The 10K company and audit company, audit firm, the accounting firm like Deloitte, PwC, or KPMG, or Ernst & Young. Apple actually paid the millions of dollars to the accounting firm to get audit. So the information here, 100 pages included in this 105 pages, is really valuable that you can use. So here you go. 17 billion, 1,802,000 shares of common shares issued and outstanding. We are using the outstanding shares, okay, as of now. So I'm going to put 17,001 point because I'm calculating all this information in million. Then how much was that? Okay, 802. So we got this 17 billion or 2 million shares common stock outstanding. Now, average coupon rate of a bond. Why do you need this? Okay, I'm not going to ask you very accurate measure of cost of debt. It's really complicated if you measure the default rate or the maturity rate or liquidity rate. As a starting point, We are just using average coupon rate of bonds for the recent 10 to 30 years the company has been issued, and then even it is already expired, because we want to know the actual credit ratings for the period, very long-term period. Okay, the Apple at this time is very good, has very high credit ratings, AA plus, but who knows what would happen in the future, right? So we are using all the different information, and then I got that information from FINRA. You may remember the class exercise when you calculated cost, the present value of the bond between the interest rate date. We use this FINRA website. So then once you got this information from the market data, okay, I'm going to show you here. You go market search. Okay, so bonds and search, issuer's name Apple, and then show result. Then you can see all the bonds the company has been issued. So 1, 2, 3, 4, many different. We see the coupon rate and then yield to maturity is much accurate, the accurate measure at this current time, but we are not using this. We are using this just the coupon rate as a ballpark, including all the credit ratings historically, right? So I calculate this, average is 2.73%. Then again, once you put the hard number, you should explain and how did you get it. And then tax rate. How about the tax rate? Where do you get the tax rate? Okay, the tax rate we can use also from, right, effective tax rate. As you can see that the provisions for income taxes, effective tax rate is 14.4%. It keeps changing, but okay, that's fine. We are using this, the effective tax rate. You can use average of this, or you can use just, that's fine, as long as you define where to get it. So 14.4%, I got it. Okay, and then the market value of debt, as I explained, just long-term debt. Okay, why? Because why do we not include this the short-term debt, commercial paper, or term debt? Oh, definitely we can use it as long as we found this short-term debt cost of short-term debt. What is the percentage is this? But when we compare the magnitude, actual volume of this long-term debt and short-term debt, we found huge difference. Okay, even you can ignore. Why? When we discount the future cash flow of the firm, the free cash flow is made by the activity of the firm that uses the financings from the bond or the equities. Yeah, it's longer than 1 year. Year 1 to 3. This, as you can see, that we are using 1 to 3, year 5. So we are not using this short term. If you really want to use this, maybe this is a commercial paper or long term debt in the short term. Definitely will have the next year or next year. Yeah, that is reasonable if you include. But as long as as long as you are using this, the short-term commercial paper and long-term term debt in short-term, you have to calculate the cost of debt in short-term, and then include this short-term debt into the WACC calculation as well. Okay, and then the market value of the preferred stock we don't have. And then market value of the common stock. How to get it? Market value. We don't use this book value. Instead, we just multiple this 121 times number of shares. Now, this shows $2.2 trillion, $2,060,788,000, which is the market value of the common stock. And then total market value of the capital resources is 22. That is the enterprise value. By the way. Okay, and then the cost of debt. You can just take this, then preferred stock. We don't have any preferred stock here. And then cost of common stock. Where is the common stock? Cost of common stock. We don't. No, we got it. We have calculated here. Required value return on equity based on the CAPA model. And then finally, let's calculate the proportion of debt times now cost of debt times 1 minus tax rate. Then portion of the common stock times now cost of common stock is not the tax deductible. The reason why we put the 1 minus tax on the cost of debt is that the cost of debt is tax deductible, right? But the cost of the common stock is not. Cost of common stock is kind of dividend, right, after net income. So we got 11.14%, which is WACC finally. That we are going to use this WACC into the discount calculation here. Once we get this free cash flows of the firm year 1 to year 5, and then from year 6 to forever, right? And then we'll discount this number, total free cash flow, the flows of the firm using this WACC into the calculation of intrinsic value of the present value, the intrinsic value of the enterprise value and the intrinsic value of the common stock. Okay, so see you in the next video clip, guys. Bye bye.